thank you all for being here this evening. So I'm Julian Treger. I joined Anglo Pacific Group about 5 years ago. We're a unique company listed on the stock exchange as well as on the Toronto Stock Exchange. And before going into the details of the company, perhaps I should just explain what our business is about. Because basically we're a finance business, but we focus on the mining sector. And the mining sector actually at the moment is having an unprecedented moment of not accessing capital. There's very little inflows to public mining funds, very little private equity, very little bank debt. And so it's a very good time for us to be a funder of the sector. And basically, we sort of do factoring. We make an upfront payment to a mine or somebody who owns a royalty, and that size is dependent upon the exact asset. And then we get returns probably every quarter from such mines. And it's quite attractive as a sort of hybrid structure. Compared to debt financing, it's not treated as debt. There's no maturity date. There's no repayment requirement. But it does come off the top line. So we get paid effectively from turnover and not after profitability. And then versus equity financing, we're not dilutive. We are quite flexible, and we're aligned with the equity interests of the company. So we are a natural partner for resource companies. Most of our royalties are focused on producing or near production mines. And you'll see the way in which over the 5 years we've managed to really grow our income as a result. But we also are increasingly looking at development stage projects because the great restriction on financing in the mining sector is particularly hurting the building of new mines. And what's interesting about the mining space actually is that every day the mines deplete, and so they need to be rebuilt, and there isn't the money going into the system to do that. So there's going to be a real supply shock coming in the next couple of years. But also, the mining sector is really interesting in the 21st century. Unlike retail or media or other sectors that are being effectively clobbered by the internet, we are a beneficiary of that. We are the raw materials for solar, for wind, for batteries, for electric vehicles, and also for the defense sectors. And there's now a global battle between the US and China on dominance economically, and there's going to be increasing interest in how those mines are funded and who is owning those assets. And I think we're very well positioned to participate in that. The other thing that's been happening over the past couple of years is that the cost of finance in the mining sector has been going up as a result of the capital shortage. And that's probably risen by 3 or 4%, which also will be good for our business going forward. So we have basically two businesses. The primary royalties business where we engage directly with a miner and give them money when they can't find it elsewhere. And then through cycle, we basically can buy second-hand royalties, often from explorers who ended up with them for almost nothing. And we can monetize illiquid assets because we're a public company with no redemption features. We have very high criteria. So although we see hundreds of transactions a year, we only do 2 or 3. And we focus really on bulk materials, base metals and energy, where for producing assets we get sort of 8 to 12 or 13% returns. For development assets, we get 10 to 15% returns. And for long duration, future opportunities, we get 15 to 25% returns. And when we look at situations, we generally only invest in very safe countries, so we don't take jurisdictional risk. We look for very good operating counterparties. We look for mines which are very low cost, so they don't stop producing when the mining sector goes down. Obviously, ESG is becoming more and more important to us. And we look for mines with long lives, with optionality, and where we are getting the appropriate strategic exposure to the minerals. So we have very high hurdles, which is why we're not a deal machine. So having talked about the background, now turning to the company. We, I think, are unique globally, and as we are the only non-precious global royalty company. And our business was really founded in the mid-90s when my predecessors bought a sheep farm in Australia for $250,000, and they thought it had gold beneath it. It didn't have gold, but it had very high-quality coal, which is used to make iron ore. And both BHP and Rio Tinto built mines underneath our land, and as a result, they owed us a certain percentage of what they were mining and selling. And over the life of that royalty, we will get back $700 million. So it will be a tremendous return. And that is the beginning of the business. I am now taking that and trying to scale it to be much larger. So we have a market cap of about 400 million pounds. We have net cash. We don't have any debt. We have 75 million of marketable securities, and we have undrawn borrowing facilities of about $100 million at LIBOR plus 275 basis points. So we can deploy, without going to the market, $150 million this year in this very tough environment. Our largest shareholders are Schroders, Aberforth, Myton, and Canaccord Wealth, amongst others, and the management own around 10% of the company. And when I joined the company in late 2013, we had almost no income, but we've really grown it very significantly since then, from 3 million pounds in 2014. Last year we had almost 50 million pounds, and this year we should have 60 to 70 million pounds of income. So we are a stock which is providing actually a lot of growth, but actually, as you'll see, also very high income and dividends. So we believe in returning about 30% of our retained income to our shareholders every year. And as you'll see here, we've deployed 130 million pounds in new acquisitions since I joined the company, but we've also paid back 60 million pounds in dividends. As we've developed and grown the company, we now have 14 significant royalties, as you'll see, in very good jurisdictions. So we really are in Australia, we're in Canada, we're in Brazil, we're in Spain. We are in also Peru, but we're not going into countries where we think there's significant risks. And you can see here also the counterparties, the operators, which include Rio Tinto, which include BHP Billiton. So we are in partnership with some of the largest and best known companies in the world. So this shows our portfolio of royalties. Our coking coal, which is used to make iron ore, is 45%, and we are reducing that with time, but it's mostly producing, and it's very, very safe jurisdictionally. Our shares have actually done very well this year. So far this year, we're up about 40%, which reflects the growth that we're seeing in the business. But what this chart shows is that despite that, we continue to be extremely cheap versus our peers. Almost all of our peers are listed in Toronto, and there's about $30 billion of listed royalty companies. But because we are in London and we don't have any direct peer, the market doesn't really understand the virtues of our model, which is to provide investors with a de-risked exposure to the mining sector. Because our income comes from the revenue line, it doesn't come from the profit line. It means that if there are CapEx or OpEx issues with mines, which often occur, it doesn't affect our income. So our income is quite stable. It's obviously been going up, but it doesn't fluctuate in the way in which the cyclical mining sector does. And that is because ultimately we are not a mining company. We are a finance company providing capital to this rather scarce sector. So in the UK, we trade as if we are a mining company, but were we to be listed and fully in Canada, we have a secondary listing there. By these calculations, we'd be trading at 2 to 3 times our current market cap. The first PNAV ratio is somewhat misleading because in Canada, our peers are valued on a 5% discount rate. We're valued here by the market at a 9% discount rate. If you were to normalize our PNAV to the same 5% discount rate, we'd be trading at about 0.65 versus the 1.5. But then you can see on the EBITDA multiple, we trade at 7, versus the peers almost 20 times. Despite our very rapid rate of growth, we are trading at under what's likely to be a 10 times PE ratio for this year. And our dividend yield, the 4% is really based upon our historic dividend. It's more likely to be 4.5%. So under all these metrics, we should be trading not at £2, but more like £5 a share if we could get the Canadian investors to come on board. We wanted to make something of the track record, having been at this for a couple of years. And you can see here the track record we showed earlier, but shown here is the way in which we are diversifying from that coal royalty in Australia, which is called Kestrel. So by 2018, the acquisitions we've made were roughly the same as the contribution of Kestrel in 2016. And as I said, this year, we expect the number to be 60 to 70 million pounds. So we can see 20 to 30% organic growth in our income this year. And that is before we deploy the $150 million of firepower we've got in assets. And if we can invest those at roughly a 10% yield, which is our aim, then that would add another 5 or 6 million pounds to our run rate. And you can see on this chart the way in which we have actually managed to reduce the Kestrel proportion over time, and that should keep going. The reason why, in part, we're going to have so much growth this year is our biggest asset, which is this coal mine, has announced that they intend to increase their production 40% this year. And in Q1, they did achieve a 20% growth. Last year, they were about 33 million pounds of our income. So if they go up 40%, that alone should add 10 to 12 million to our income, which equates to about 25%. And then there are a couple of other royalties which will be producing additional income for us. We wanted to show here as well our capital allocation history. So as I said, we've invested about 130 million pounds. And part of the style that we follow, which is the only way really to make money in the mining sector, is to be contrarian and deep value. So we try to anticipate how the mining cycle is going to work, which commodities are cheap. You've got to buy cheap to make money in the mining space. So we bought vanadium in 2014 when it was half the price of today. We bought thermal coal, which was about 2/3 of the price of today in 2015, uranium in 2017, and last year we bought iron ore, a very high quality iron ore, and pellets. And that's also done well in part because of the tragic events in Brazil with the dam breaking. And so what we show here is our acquisition considerations, the estimated DCF value, and then the cumulative income and the total income as a percentage of acquisition price. And this implies that our returns are in the mid-teens for these investments. Our balance sheet value takes acquisition consideration and amortize it over time. So we only write it down, but the DCF value shows, in fact, the true value that's been added by the management over the last couple of years. One other thing I think it's worth mentioning is that strategically for the past couple of years, not only have we been diversifying our business, but we've also been focused on encouraging the development of high-quality minerals, which are less contaminated, less polluting, which are better for the world. And that's actually been a good business decision because over the past couple of years, as the ESG agenda has increased, pricing for commodities has exploded like this, but really dirty, polluting commodities have become increasingly taxed and unsellable. And the really good premium commodities have become increasingly valued and are getting higher pricing. And so part of the business that we are pursuing is to try and have the world use better quality commodities which are purer and better for batteries. And you can see on page 19 of this presentation the way in which the commodities that we've selected have performed and significantly outperformed gold, which is only up by 23% over the period that we are showing here. We've done particularly well with vanadium, which went up very significantly. It's come down a little bit recently, but we continue to be positive about it. This page looks at our sustainability profile, just to pick up on that point, because effectively, since we aren't actually mining, but we are looking at the whole sector, we are able to police the sector and look at how the counterparties are behaving from an ESG perspective before we give them money. So I think one of the things we are working on is how we can raise our profile and explain to the broader investment world that we are effectively pushing the ESG agenda and endorsing companies which are good behaviors in this space. And we are working on policies as well, which could include sanctioning or blackballing or naming and shaming companies which are not behaving to the highest standards. So we think we're going to have a very strong year. We're very confident both from Kestrel and from an investment we made last year in iron ore, the Labrador iron ore one. That investment produced 1.9 million pounds of income for all of 2018, but it's produced 1.7 million pounds of income for the first quarter of 2019. And if you annualize that, that's another 5 million pounds of income. So we think we are going to have a very strong year, and we are extremely well positioned to put money to work in an environment which is very capital constrained, and in a sector which I think over the next couple of years is going to see supply shocks which are going to lead to much higher pricing. And we've started to see that coming through already. If I just flip on through the portfolio to the first quarter results. So in Q1, which we announced 2 weeks ago last year, we only had income of £8 million. This year, we've had income of £17.5 million, so more than 100% increase. That's not a rate that we expect to continue all year, but it does give us confidence. And the difference of £10 million, basically just in Q1, that delta, if you apply it to our tax rate, which really just drops down, equates to 4p per share of earnings alone, and you would expect us to share a proportion of that with our shareholders. So there is also definitely the expectation that our dividend, which is progressive but sustainable, will increase during the year. And our model is a very interesting model. When I joined the company in 2014, the overheads were at £5 million and our income was £3 million. Last year, we had income of £50 million and our overheads were still £5 million. We don't have to scale the overheads in order to grow the business. And indeed, we could probably be running a £100 million a year income business with the same overhead structure. So the income just drops to the bottom line after we pay taxes. So I think it's a very interesting business, a very interesting model. We are going to be scaling it, but it's something, as with the previous speaker, we need to shout more about so that people can understand what is often not a very obvious model. But thank you all for your time.